Beach Boys! How's it going, Connor?
Good. Another good week.
Another good. I think we start out the show the same way every time.
I don't know how else to answer that question, but
Huh?
I don't know how else to answer that question, but
Yeah.
Well,
you could be doing pretty bad.
That's true. That's true.
Maybe we should. This should be a therapy session for us.
Well, we get to finish our Whitepaper series today. Hopefully, if we can get through it all.
Yeah, we're thinking now the last sections are a little shorter, so I think we're just gonna try and send it, go all the way.
Yep.
And I think we left off at 6 last time, right?
We did. So we covered in the past. If you haven't seen the past, we put it in a playlist on our channel. So if you want to watch them all in order, you can. But we've gone through the introduction. We've gone through transactions. We've gone through the timestamp server. We've gone through proof of work, the network, and the incentive. And so now we are, ironically, the further you go through the paper, the more Bitcoin Cash becomes Bitcoin. The more the core narratives kind of fall apart, which is interesting. But because we mentioned if you go back and watch, the first 3 sections really describe the quote unquote blockchain, right? So everyone tells you now, especially if you're involved in all these scam groups, blockchain groups, everyone tells you now that, Bitcoin's innovation was the blockchain. And so now we need the generation 2 and generation 3 blockchains, right?
Right.
But in reality, Bitcoin's innovation was really the rest of this paper. Obviously we went in the second one, we talked about kind of the economic model of who's the nodes in the network and what are they doing? What's their purpose? Covering the incentive model as well. But so now we kind of come into if we're going to use the white paper, right, then now we have to, how's this going to work in theory, right? Because if everyone isn't a node in the network, how are we going to operate with the network that's going to grow in size and all that kind of stuff, right? But it's all here. It's still all here, right? So we're going to keep just kind of doing the same thing. We're going to read it out loud, and then again, we're going to get through the rest of the paper here. So it's a little dense at some points, but some of this is pretty bare bones, and it's really pretty straightforward, I think. There's a lot of interesting stuff in here that you can look into yourself, but for the most part, this is all pretty simple stuff to understand. So we'll just jump in. So section 7 is reclaiming disk space. So once the latest transaction in a coin is buried under enough blocks, the spent transactions before it can be discarded to save disk space. To facilitate this without breaking the block's hash, transactions are hashed in a Merkle tree, with only the root included in the block's hash. Old blocks can then be compacted by stubbing off branches of the tree. The interior hashes do not need to be stored. So you can actually see what this is talking about in this description. But the gist of it here is that you don't need to store all the transactions to know that a block is valid, right? So that the gist of the idea here is that once you've validated a block, one hash of the root of the Merkle tree is really enough for you. You can, and this is kind of talked about a lot, right? Because everyone says, well, I need to run a fully validating node at home. But really what you can do at home is just store all the hashes of the blocks, right? Which would save you a lot of space. So then he goes on here to say, a block header with no transactions would be about 80 bytes. If we suppose blocks are generated every 10 minutes, 80 bytes times 6 times 24 times 365 equals 4.2 megabytes per year. With computer systems typically selling with 2 gigs of RAM as of 2008, and Moore's law predicting current growth of 1.2 gigabytes per year, storage should not be a problem, even if the block headers must be kept in memory, right? And of course, he's describing miners, right? He's not even necessarily describing, he's really just describing mining nodes and how are they going to kind of scale with the network. This is already pretty much covered here. So really pretty straightforward, but really the beauty of it is, and if you are curious about Merkle trees, maybe we'll put some stuff you can read in the description. But I mean, really Merkle trees are pretty fascinating, and what you're able to do with them is it's pretty cool. Pretty cool stuff. So
really is just like a makeup, if you would imagine like a tree, leading up, the branches leading up to it. If you have that solid like foundation, that solid root, you kind of can validate all the things in the end that says that that's a valid like apple tree or something like that,
Yeah.
And you kind of see through the picture too a little bit. The 0 and the 1 go together to make #0, and then everything kind of leads up. Everything kind of builds up on top of each other.
And the other, I think what's interesting, right, is that this is really talking about pruning data too, right? Reclaiming disk space. So this is I mean, again, right? It's pretty interesting because we still, even in the Bitcoin Cash world, had the debates about like, memo.cache and all this other stuff. As if like miners can't prune data from their node, right? They don't need to store the op return associated with a transaction from 20 blocks ago if they really don't want to, right? There's nothing forcing them to do that. So it's just interesting. Interesting again. We're still dealing with some of this stuff. But they're just misconceptions, I think, or I don't know. But
yeah. All
anyway,
right.
That's section 7. Yeah. So
yeah.
Over here.
Go to section 8, simplified payment verification. It is possible to verify payments without running a full network node. A user only needs to keep a copy of the block headers of the longest proof of work chain, which he can get by querying network nodes until he's convinced he has the longest chain and obtain the Merkle branch linking the transaction to the block it's timestamped in. He can't check the transaction for himself, but by linking it to a place in the chain, he can see that a network node has accepted it, and blocks added after it further confirm the network has accepted it. And I'll just go. As such, the verification is reliable as long as honest nodes control the network. But is more vulnerable if the network is overpowered by an attacker. While network nodes can verify transactions for themselves, the simplified method can be fooled by an attacker's fabricated transactions for as long as the attacker can continue to overpower the network. One strategy to protect against this would be to accept alerts from network nodes when they detect an invalid block, prompting the user's software to download the full block and alerted transactions to confirm the inconsistency. Businesses that receive frequent payments will probably still want to run their own nodes for more independent security and quicker verification.
Wow. I mean, so this is actually very interesting, right? This section right here pretty much does not exist today. I mean, SPV as described here in the white paper does not exist today. Except, ironically, I pulled this up while you were talking. I meant to mention this. I think it's a good time to mention it. NextCache is a entirely new implementation built, and they built an Android SPV wallet, right? And so they mentioned it. This is all today. I mean, I found this today. I downloaded it, used it, and you can see here, any Bitcoin Cash wallet that does not require an initial block download when first installed is not pure SPV and requires a centralized service to function. So NextCache requires no centralized service. This is actually true. This is, I think, the first actual SPV wallet I've seen. There might be another one out there, but I haven't seen it, and definitely not on Android that I could tell. I mean, I guess I don't know. Electron Cash might qualify. I'm gonna look like an idiot if Electron Cash does qualify. But this here, basically, I downloaded the wallet, and it actually took about, for me, I was on a fast connection. It took me about 30 minutes or 20 minutes, and it synced with the network. But you have to see here, right? I mean, basically, you have to catch up to the network, and then now you can now you can follow along with the network after you've kind of caught up with, okay, I have the hashes, right? And so there's a lot to break down here, but I just wanted to call them out. That's really cool that they did that. Next cache at cache next. A little confusing, but next cache at cache next, you can get a link to their beta Android wallet. So I thought that was just really cool. Really ironic that came out today as we're talking about this too. So,
yeah.
But
just to even go back further too, before that, the first sentence in this section, it is possible to verify payments without running a full network node. I mean,
whoops.
That's the whole argument on the core side, is that everyone needs to run a full network node. You know, it's just not necessary.
Well, and to be fair, core, like people like Luke Dashier and stuff, like they just say Satoshi is wrong. That at least this part is talked about. I mean, not really, I guess, but they just say Satoshi was wrong. This doesn't work, and then they give a lot of BS about it. Without, again, identifying that really, again, the first SPV wallet, I'm pretty sure to exist, came from Nextcash. So, today. I'm pretty sure that's true. But again, right, this also talks about something else. This goes into a lot of other things that we've talked about a lot in the show, but SPV works because you accept the longest proof of work chain as the valid chain as well, right? That's another thing. Everyone says, like, Satoshi didn't describe valid, invalid blocks or anything like that. Again, it's kind of explicitly defined here because it's saying in order for SPV to work, you have to accept the longest proof of work chain as the valid chain.
Right.
Yeah. I mean,
one thing that we mentioned too is like by querying network nodes. We've talked about querying the network so much, you know, as an outsider, not as a home user or a business merchant, you know, you query the network to figure out, you know, whether your payment has been verified. And we actually, I'm going to plug our ZeroConf episode because I feel like we kind of got a little bit into this aspect of it, where it talks a little bit on the bottom there about, you know, detecting an invalid block, you know, prompting user software, you know, to alert the customer or alert the merchant.
This is what's interesting, right, is it says here the verification is reliable as long as honest nodes control the network, but it is more vulnerable if the network is overpowered by an attacker, right? So this again kind of, and you actually we get into this in the calculation section. This pretty much talks about why that's true mathematically. But
I was about to start going into like the risk analysis aspect too.
Yeah, I mean, again, a risk analysis is a perfect way of saying that because he even specifies here, this is exactly what the money button is doing today. Businesses that receive frequent payments will probably still want to run their own nodes for more independent security and quicker verification, right? I mean, the money button is running servers across the globe for this exact reason to do this. Coinbase would be a good example of a company that would do this. So it's just very interesting. Like, I mean, this is all, again, very explicitly kind of written out how this should work. Anyway. Yep. So hopefully we start seeing stuff like this. But this really doesn't, people are building software to detect double spends and things like that. But an invalid block, Satoshi, again, accept alerts from network nodes. So if you're not that mining node, you're not the network node. So, and we're kind of beating a dead horse here for this one, right? But SPV, it works. There's a lot of wallets that are like wallets, right? And they kind of have that server that functions as the SPV. But anyway, so yeah.
And I think it's also just important to note that the Section 8 is more for like, I mean, we've kind of been beating a dead horse here, but it really is for like the users and the merchants, and it's not about how these users and home nodes can build on top of the network. Well, not build. They can build software and things like SPV wallets, but I'm saying more like they can't build the network. They can't contribute to the network. It doesn't say anything about these home nodes doing anything.
Having it govern. Yeah. They sure don't govern. Yep.
Or like contributing at all to like continuing the blockchain. Like it doesn't say anything about that. It's just, hey, this is a simple way to verify your payment and make sure that it goes through.
Yeah.
You don't actually contribute any work. It's just kind of for their own benefit,
It's a good point, right? Because it even, again, explicitly defines them as watchers, right? They're more of observers of the network than they are participants.
Right.
Yeah. Mm-hmm. That's a good point. So, I mean, yeah, again, I'm going to beat the dead horse one last time here.
Yeah.
It's just very interesting. I think why it's hard for us to not beat the dead horse on it is because, again, it's all implicitly spelled out here, and yet people are going to turn around and say that's not how the network was supposed to function. So I think it's actually worth beating the dead horse a little bit because it's all here, right? So anyway, let's move on. We're making good time.
The horse is dead. The horse is dead.
Horse is dead. So combining and splitting value, right? So this is actually, this one really isn't important for anyone to really know, but I think the reason why this is important is because if you go look on like a block explorer, people are probably pretty confused. Like, I know I was, like, when you first make a Bitcoin transaction and you go and look at a block explorer for your transaction and you want to make sure the money got sent to wherever you're going, right? And you see inputs and outputs, it's really quite confusing. So this kind of explains that a little bit in detail, but so we'll cover this one real quick. So combining and splitting value, section 9. Although it would be possible to handle coins individually, it would be unwieldy to make a separate transaction for every cent in a transfer. To allow value to be split and combined, transactions contain multiple inputs and outputs. Normally, there will be either a single input from a larger previous transaction or multiple inputs combining smaller amounts, and at most 2 outputs, one for the payment and one returning the change, if any, back to the sender. It should be noted that fan-out, where a transaction depends on several transactions, and those transactions depend on many more, is not a problem here. There is never the need to extract a complete standalone copy of a transaction's history. So, again, this is pretty straightforward. Maybe I can even just pull up a transaction real quick to help people understand what this means here. So if I pull up a transaction here, let's see.
I mean, correct me if I'm wrong, it's a lot just like change, Like if I give you a 20 and maybe my product's only $12 and like the $8 my change, the 12 going in, like that's pretty much kind of the motive of this, right?
Exactly. Yep, exactly. Yeah. And you can see as a pretty simple example, right? It specifies specifically a single. Normally there will be either a single input from a larger previous transaction or multiple inputs combining smaller amounts, and at most 2 outputs, one for the payment and one returning the change, if any, back to the sender. And so you can see here, you actually end up with 1 input, 2 outputs, right? So, anyway, very straightforward. But
I guess it's also important to note, like in this section too, that this kind of opens up the door for it to be split up into smaller and smaller values too. Just because I feel like I've heard before people say like, well, like do you have to have a whole Bitcoin like to have a Bitcoin? Like, pretty much like. You can't have a segment of it. Like, they didn't think that you could have, like, a quarter of a Bitcoin,
Right. So
this combining and splitting values section kind of just explains how it could be reduced to a smaller amount.
Yeah.
Because there is, I think it was on, like, CNBC one time. They were like, within the past year, too. They were like, yeah, I'm going to get my kids Bitcoins for Christmas. And they're like, how does that work? Do you have to have, I think you have to buy like 1 whole Bitcoin each. That's going to get pretty expensive.
Yep.
Just like, No, that's not how it works.
Nope. And this is also, to even harp on it further, this is why for a lot of businesses like Bitcoin.com and this happened for exchanges too. When they're taking in a lot of transactions and then combining the inputs to one output, maybe to combine their money and actually take payments in, that costs them a lot of money. So the amount of money that you're spending is going to be dependent on the inputs and outputs in a transaction. And so I know Roger was saying at one point he was spending an insane amount of money on fees because, as a merchant, he's taking in a ton of inputs. So when the fees are high, this makes things, depending on how you want to do things, the fees can rack up quite high. So anyway, let's move on. Section 10.
All right. Section 10, privacy, which is a very confusing part, I think. Section 10, privacy. The traditional banking model achieves a level of privacy by limiting access to information to the parties involved and the trusted third party. The necessity to announce all transactions publicly precludes this method, but privacy can still be maintained by breaking the flow of information in another place, by keeping public keys anonymous. The public can see that someone is sending an amount to someone else, but without information linking the transaction to anyone. This is similar to the level of information released by stock exchanges, where the time and size of individual trades, the tape, is made public, but without telling who the parties were. As an additional firewall, a new key pair should be used for each transaction to keep them from being linked to a common owner. Some linking is still unavoidable with multi-input transactions, which necessarily reveal that their inputs were owned by the same owner. The risk is that if the owner of a key is revealed, linking could reveal other transactions that belong to the same owner.
So Yeah. So this is, so is Bitcoin, right, an anonymous currency? No, it's not, right? And this is pretty explicitly defined here. It's saying that really if you can link just one transaction to a person, then the rest of the linking is unavoidable because you can pretty much track their inputs and outputs and, find out all the history of your coins, right? Mm-hmm. So really Bitcoin is a very non-anonymous currency. It would be what we would call a pseudo-anonymous currency where you're getting linked to these public transactions where if the link between identity and transaction is made, then really everything is there. Now, there's two things kind of at play here. So it talks about, there's an image here of the traditional privacy model, which really links the identity to the transaction, which goes to a trusted third party, which then goes to the counterparty, and all of that is public, right? The new privacy model would be...
Most of that's private, though.
Oh.
Like, most of that information is all private, though.
Sure.
Like, the transactions are kept internal within just the two parties involved in the third party.
Yep. Sorry.
So, but there's more information that you have to give between those parties to the trusted third party. So that really puts an emphasis on that trusted third party because they now have a bunch of information about everyone inside there. So essentially it's a closed door where the traditional privacy model is, but it's a very vulnerable and susceptible door to a lot of releasing of information.
Mm-hmm.
Yeah.
Yep. Exactly. Yeah, that's a good point. And so what's even almost so more interesting here is that it's it's not anonymous in the sense that like Monero, right? Monero, the whole idea of Monero is that every transaction is untraceable in everything you're doing. Really, I think what's kind of more, what's almost the most interesting is that this entire privacy model is pretty much broken by exchanges. You kind of go back to this traditional privacy model where in order to get Bitcoin today, you need the trusted third-party even exchange. And so really this model itself is, Bitcoin has yet to really route through this new privacy model because everyone is under this old, in order to get Bitcoins, you have to go through that same process of going to a trusted third party, which I think is why it's, this really, Satoshi wasn't talking about 5 years down the road. I mean, if you're talking about a future economy built on Bitcoin, this new privacy model becomes realistic when, just like cash, when you're getting paid in Bitcoin, when Bitcoin is getting moved a lot. But with that said, it's still a traceable currency. It's really, all the transactions are traceable. And if you can link identity one time, like Satoshi says, it's all kind of linkable. But with that said, you can still have privacy maybe without anonymity, right? And this is something that, you see some people make the distinction. And it is a pretty interesting distinction, right? Having privacy, but having anonymity are two different things. If you can keep all public keys involved in a transaction anonymous, then you have an anonymous transaction. The technical abilities of doing that, people are working on. They want to solve that problem. But there's also a big difference between having everyone anonymous and also keeping the actual transaction itself private without other people seeing into that transaction and figuring out who did it go to and things like that. But maybe the two people involved would want to keep it private but not anonymous, if that makes sense. So
it's like not 100% anonymity, whatever. You know what I'm trying to say.
Yeah.
But it's like up to a degree of it.
Right.
You kind of pay for how much privacy you want in a way.
Yeah. And I'm really curious how this evolves in the Bitcoin space. It's interesting to me that this is in the paper. It's interesting that it's in the paper. It's interesting that pretty much Bitcoin is the least private thing out there with respect to I want to do something. I mean, this is what's interesting about the Silk Road stuff, right? Is that, I mean, really, if you wanted to make transactions without repercussion, Bitcoin was not the best choice. You know what I mean?
Right.
I would be very wary about making an illicit transaction with Bitcoin, which makes it even more interesting when everyone says it's used for money laundering and things like that. But because it's, it's not US dollar cash, which is the biggest money laundering instrument in the world. But
right.
Anyway, it's interesting that this is a section in the white paper. It's very interesting. And I'm curious how this will evolve with Bitcoin. Because I think Satoshi was really, I mean, this doesn't work. This isn't, Bitcoin isn't really a private system. It maybe it can be. Maybe it can be. I don't know.
Yeah.
I'll be curious.
Not yet.
Yeah.
But
so
I think when we start getting into maybe decentralized exchanges will be the beginning of it.
Well,
I don't know if it'll handle it completely, but I think it's going to take a while to get to that new privacy model completely. But I think if decentralized exchanges are coming.
I don't think it happens until the idea of exchanges is gone. I mean, you know what I mean? I mean, this whole idea of the whole idea of you having to go buy Bitcoin through some kind of party, every single US dollar money thing is regulated to all high hell. So if you think that, there's nothing really private about doing anything with US dollar, no matter if it's decentralized or anything like that. I mean, unless you're shipping cash in the mail, right?
Right. Well, I'm thinking more along the lines of a decentralized exchange in terms of a tokenized world kind of thing, exchanging goods and goods online through a decentralized exchange.
Right.
But you're right though, with regulation and everything, I'm sure that there'll be some gate to get into the decentralized exchange until maybe that's gone. Yeah.
Well, I think that's why, Ryan Charles talks about it. He calls it the onboarding problem, right? I think the best way to solve the onboarding problem is I mean, it inherently has to be through earning. I mean, how do you get people to earn Bitcoin, right? That's really probably the best way to kind of onboard people. You know, I don't know. Interesting. I'm curious how this evolves for sure.
Yeah.
But so this section here, this is an interesting section. This is section 11 is calculations. So I actually have some tabs open as we go along. We can pull up some of the stuff that's mentioned in here. But I just realized I forgot to pull one of them up. But what's interesting about this section is that, like, it's a lot of math maybe, but the concept is really quite straightforward. And we're going to try and explain that. So bear with us if you're confused. All right, so we consider the scenario of an attacker trying to generate an alternate chain faster than the honest chain. Even if this is accomplished, it does not throw the system open to arbitrary changes, such as creating value out of thin air or taking money that never belonged to the attacker. Nodes are not going to accept an invalid transaction as payment, and honest nodes will never accept a block containing them. An attacker can only try to change one of his own transactions to take back money he recently spent. I want to stop here real quick, right? Because again, this is very interesting.
That's
good. The Miner's Choice Initiative was exactly talking about this right here. Everyone criticized the Miner's Choice Initiative where they said we're going to orphan blocks that have double spends in them, all that kind of stuff. This is exactly what it's talking about. Exactly what it's talking about. Nodes are not going to accept an invalid transaction as payment. And honest nodes will never accept a block containing them. Right?
Mm-hmm.
An attacker can only try to change one of his own transactions to take back money he recently spent. Assuming the attacker is a node or a miner. Right?
Right.
Okay. All right. So let's keep going. So, the race between the honest chain and an attacker chain can be characterized as a binomial random walk. The success event is the honest chain being extended by one block, increasing its lead by +1, and the failure event is the attacker's chain being extended by one block, reducing the gap by -1. Okay, so this is the one I forgot to bring up, actually, and I meant to get a better link. But I have Wikipedia here. This probably isn't going to make any sense to anybody. But it's really a pretty straightforward concept that I think actually he tried to explain pretty simply, right? So a random walk is a mathematical object known as a stochastic or random process that describes a path that consists of a succession of random steps on some mathematical space, such as the integers. An elementary example of a random walk is the random walk on the integer number line z, which starts at 0, and each step moves +1 or -1 with equal probability. Okay? So if that confuses you, just think of a line, and the direction that a point on the line moves is 50-50, either going +1 or -1. Okay? That's really all Bitcoin here is describing. The general idea is that the probability of an honest node finding a block and the probability of a non-honest node finding a block, assuming equivalent hash rate, would be 50%, 50%. And so really this is just very simply describing that if the honest chain wins the block, the lead is advanced by +1. And if an attacker chain gets a block, it reduces that gap by -1. Okay, so, and again, we'll put links to all this stuff if anyone's curious, but all right, so the probability of an attacker catching up from a given deficit is analogous to a gambler's ruin problem. Suppose a gambler with unlimited credit starts at a deficit and plays potentially an infinite number of trials to try to reach break even. We calculate the probability he ever reaches break even, or that an attacker ever catches up with the honest chain, as follows. And before we go further there, a gambler's ruin problem. Okay, so if you don't know what a gambler's ruin problem, it's me when I go to the roulette table. It's the idea that if I keep betting money, I'm somehow going to win, right? The original meaning is that a persistent gambler who raises his bet to a fixed fraction of bankroll when he wins, but does not reduce it when he loses, will eventually and inevitably go broke, even if he has a positive expected value on each bet. Okay. Another common meaning is that a persistent gambler with finite wealth playing a fair game, that is, each bet has expected value 0 to both sides, will eventually and inevitably go broke against an opponent with infinite wealth. Such a situation can be modeled by a random walk on the real number line. In that context, it is provable that the agent will return to its point of origin or go broke and is ruined an infinite number of times if the random walk continues forever. Okay. So, you don't have to go too far into this, but if you are curious more about it, we'll put a link. But this concept is really just, okay, if an attacker wants to attack the chain, assuming that they are the minority, because that's what this whole assumption is, right? That the honest nodes outnumber the non-honest chain. So we're going to walk through the math here. Again, pretty straightforward. It may look confusing, but P equals the probability an honest node finds the next block. Q equals the probability the attacker finds the next block. And Q sub Z is the probability the attacker will ever catch up from Z blocks behind. Okay? So the attacker will only ever catch up from Z blocks behind if the number of honest nodes is less than the number of attacker nodes, right? That's really pretty straightforward. It's equal to 1, meaning it will happen if the non-honest nodes outnumber the honest nodes, okay? This other one is just Q divided by P to the power of Z. If the honest nodes outnumber the dishonest nodes, then you have this relationship Q divided by P to the power of the number of blocks as you go further, right? And if you have any kind of basic understanding of like calculus or whatever, I don't know what this would be, algebra, but I think it's algebra, whatever. Maybe calculus, I don't know. But this really ends up being, okay, well, as the number of blocks increases, this fraction gets smaller and smaller, right? So if we go through the paper here, given our assumption that P is greater than Q, the probability drops exponentially as the number of blocks the attacker has to catch up with increases. With the odds against him, if he doesn't make a lucky lunge forward early on, his chances become vanishingly small as he falls further behind. Okay, so again, this is really just saying, given our assumption that P is greater than Q, given the assumption that honest nodes outnumber dishonest nodes, the probability drops exponentially. So very quickly, the attacker loses in this system. Okay. We now consider how long the recipient of a new transaction needs to wait before being sufficiently certain the sender can't change the transaction. We assume the sender is an attacker who wants to make the recipient believe he paid him for a while, then switch it to pay back to himself after some time has passed. The receiver will be alerted when that happens, but the sender hopes it will be too late. Okay? So this is describing an actual double spend attempt. This is where a miner reorganizes the chain, rebuilds the chain with the entire intent of double spending money. Right? And by the time it's been found out, the sender will have gotten away with theft, essentially. Okay? The receiver generates a new key pair and gives the public key to the sender shortly before signing. This prevents the sender from preparing a chain of blocks ahead of time by working on it continuously until he is lucky enough to get far enough ahead, then executing the transaction at that moment. Once the transaction is sent, the dishonest sender starts working in secret on a parallel chain containing an alternate version of this transaction. The recipient waits until the transaction has been added to a block and Z blocks have been linked after it. He does not know the exact amount of progress the attacker has made, but assuming the honest blocks took the average expected time per block, the attacker's potential progress will be a Poisson distribution with expected value lambda equals z times q over p. So, to get the probability that the attacker could still catch up now, we multiply the Poisson density for each amount of progress he could have made by the probability he could catch up from that point. So this is probably where a lot of people that didn't take calculus, this would be calculus for sure, probably get lost, right? But we're going to keep going because, again, just stand by here. So rearranging to avoid summing the infinite tail of the distribution, you get this other fancy equation. He then writes some code out to show how this would look in C code. And if you want to go into Wolfram Alpha or anything and you want to test this for yourself, you can see that returning for some results, assuming again, so here Q would be 0.1, right? So this is assuming that maybe the attacker has 1/10 of the network. You can still see the probability drops off exponentially. So as maybe at 0 blocks, they have that 100% chance probability of maybe attacking the network, right? But then as one block is found, their probability drops all the way to about 20%. As another block is found, 5%. As a third block is found, 1%, and then drops off exponentially, keep going, to the point where it's not feasible. So this is the entire idea of a 51% attack, right? This is why everyone talks about these things called a 51% attack. Because in order for this to really be successful, this idea of I'm going to rewrite the chain, you better have a hell of a lot more than 0.1% of the network. And even if you have 0.3, so assuming they have 30% of the network, z equals 0, p will be equal to 1 still. What we just got confused about here, z then jumps to 5, which then you get this 17%, right? So it took 5 blocks now to get to this 17% of the network. And you can see here, no matter what, it still drops off exponentially. So even with 30% network, you really don't get the advantage that you need. You really need more than 50% of the network to win. This here, solving for p less than 0.1%, you can see here that really, really, this is the gambler's ruin problem in play. What you're talking about here is really, okay, you're not going to be able to catch up unless you have over 51% of the network, right? So, okay, we've kind of gone all over the place here, but
yeah,
maybe if we can step back here. I did pull up like a Poisson distribution and what that is. I don't know if that's really that helpful for people to understand, but really like any kind of statistical distribution, but specifically a Poisson distribution, just expresses the probability of a given number of events occurring in a fixed interval of time or space if the events occur with a known constant rate and independently of the time since the last event. So the reason why this is important is because this is mining, right? Every time a block is found, the probability of the next block being found is completely independent of the last one. Because again, you're just solving this hash puzzle. So if I'm interestingly, the selfish mining paper argues that this is all flawed. This is where the concept of mining having memory and all that kind of stuff comes into play. I think I'm going to actually stop there because I don't want to confuse anybody when we're talking about the white paper. But we still haven't done our selfish mining episode and plan on doing that at some point. But anyway, this is the calculator section. But again, all this is really saying is that the honest nodes win, assuming they have the majority. Yeah. Did we cover it all? I mean, is this straightforward enough? I know this is probably a little confusing to some people, but
I thought you did a pretty good job.
This is good because
I just kind of sat back and let you do it.
That's all right. I mean,
so you were on a hot streak, so I was letting you go.
This is good because this really again gets to the root of this is showing Bitcoin works. This is really showing all it took was this section here to explain to people the system works. Again, assuming the honest nodes control the network. So, and if it wasn't clear from our other episodes, the incentive to be honest is there. So really, the more expensive mining hardware becomes, the probability of an attacker ever having the network is minimal. Because this is what's going to be interesting, Corey, because this is going to be the next line this is going to be the next line. I can guarantee this is how the narrator is going to go next. There's going to be a group of people that have over 50% of the hash rate that do something, and they're going to be called the attackers. And maybe someone with enough propaganda behind them is going to say that, well, look, it's spelled out in the white paper that this system breaks down if the attackers gain majority control of the network, right? But when Satoshi describes attackers, he's describing people double spending coins. He's describing people. He's not describing. In fact, I don't want to get into it because I'm just calling it out. Let's just put this on record right now. That's what's going to happen. Everyone's going to say, "Look, the white paper said what to do. Said that if the attacker has majority hash rate, then the system breaks down." Ignoring the fact that if I'm someone who's put billions and billions of dollars into mining, I want the system to work and I want to be an honest node. So anyway, I'll get off I'm just telling you that's what's going to happen. That's going to happen come November when the people that no one wants to have majority hash rate has majority hash rate. So
it's like people completely forget the incentive section of the white paper when they start thinking about all the math and everything.
It's weird.
It's
almost like
they take out the human factor, the human aspect of mining.
It's almost like a lot of people haven't actually read this paper. I don't know.
Yeah.
Maybe I'm wrong. But anyway.
I think there's a little bit of confusion too. Like people think that people get confused with the term 51% attack and assume they make the assumption that anyone or any party that has more than 51% of the network is going to attack it. Like that's just, if it's greater than 51%, they just automatically insert 51% attack.
Right. Yep.
Ideally, we wouldn't like to have 51% controlled by more than one party, but if it was a temporary situation where the honest chain was going, that's what it is. That's what happens, and that's what Bitcoin was created to incentivize, that kind of system.
Well, and it's also worth noting that, we spelled it out the other day, or in the other episode, but he even says it's not that big of a deal if someone gets that majority. It's written in the white paper here. I'm trying to remember where it is, but basically all that can happen, right, is that double spending. The double spending of, maybe you would have the ability to do in this calculation section the reversing of payments, but maybe, again, it takes out the economic motivations of merchants and of players in the network. So anyway, let's wrap it up here.
12 conclusion, and I'm just gonna apologize too. It started pouring here, so if anyone's hearing any raspy noises, that's the rain.
I can't hear it. Don't worry.
It's just it's God crying about the conclusion of the white paper, the Beach Boys white paper. All right, 12 conclusion. We have proposed a system for electronic transactions without relying on trust. We started with the usual framework of coins made from digital signatures, which provide strong control of ownership, but it is incomplete without a way to prevent double spending. To solve this, we proposed a peer-to-peer network using proof of work to record a public history of transactions that quickly becomes computationally impractical for an attacker to change if honest nodes control a majority of CPU power. The network is robust in its unstructured simplicity. Nodes work all at once with little coordination. They do not need to be identified. Since messages are not routed to any particular place, and only need to be delivered on a best effort basis. Nodes can leave and rejoin the network at will, accepting the proof of work chain as a proof of what happened while they were gone. They vote with their CPU power, expressing their acceptance of valid blocks by working on extending them and rejecting invalid blocks by refusing to work on them. Any needed rules and incentives can be enforced with this consensus mechanism. Boom, baby.
Boom. This paragraph actually does a very good job of really wrapping it all up, right?
Yeah, it really did. I mean, the one sentence that stood out for me, like, is the, what you just said, what you were just looking for. If honest nodes control a majority of the CPU power, right there.
Mm-hmm. Yep. Computationally impractical for an attacker to change if honest nodes control the CPU power. And what's, I think if it isn't clear yet, the point here is that the beauty of mining, right? The beauty of the Stackelberg competition, right? The beauty of, okay, you need to invest, like, as it becomes an arms race to gain the majority of CPU power, the more likely it is that someone is an honest person that's mining. And that might seem like a little weird to people, but like for example, in a proof of stake system, right? If I want 51% of the network, if I want to be this quote unquote attacker that Satoshi is describing, all I have to do is buy my way there, right? Now, but not only can I just buy my way there, I can buy my way there, sit on it, and get more and more money, and get more and more share of the network, right? That's what the proof of stake model talks about. In mining, yes, is it quote unquote I can buy my way there? Sure, you are buying the equipment, right? But on the other hand, you're still gaining that. You're in that constant state of competition. You can't just sit on your pile of money and make more money and therefore get more power, right? You have to spend money. You have to deploy hardware. You have to maintain the hardware. You have to be an active participant in the network that's continually putting investment into it. So someone that's going to continually put investment into something, the honesty comes naturally. The honesty comes naturally because they don't want this to fail. They want this to work because they want their investment to increase in value, right?
Right.
I think that a lot of people just, the flies over their head, but
yeah. Like the proof of stake, I don't know, to me it just seems like there's no threat to your stake at all ever. But with the proof of work kind of mindset, there's always a threat. Like you have to stay up to date with things. You have to keep up to date with like all the certain hardware and everything. You're always like kind of feeling someone coming down your neck, that someone's there, you know?
Yep.
The proof of stake, you just sit on it. You don't have to do anything. Yeah.
Yeah, exactly.
So... Yep.
And this is, every sentence here, every sentence here is, again, it's a microcosm of the whole paper. But so I want to also call out the network is robust in its unstructured simplicity. I think it's a powerful sentence too, because it's again a lot of core in their history. They did the opposite of this statement. They thought that it needed to be more complex to be robust, and I think it's really straightforward that it's outlined here that it is robust in its simplicity. This is another one. Nodes work all at once with little coordination. This is interesting in the context of the pre-consensus stuff being pushed by ABC right now. No coordination. No coordination while nodes are working. Messages are delivered on a best effort basis. This talks about the necessity to actually do the proof of work, right? Not just find the hash, but to be well connected, right? That's written in this sentence here. This next sentence, accepting the longest proof of work chain is the proof of what happened while you're gone. Meaning that in order for this system to work, the longest proof of work chain is the governance model. It has to be the governance model. And if that isn't clear to you enough, They vote with their CPU power. Voting, governance is done with mining share. Expressing their acceptance of valid blocks by extending them, and rejecting invalid blocks by refusing to work on them. Any needed rules and incentives can be enforced with this consensus mechanism. Anyone who tells you that anything else but mining in this system should be used to enforce new rules is not talking about Bitcoin. They're not. So, that's all there is to it.
I like that. That conclusion's pretty just jam-packed.
It is.
Sums up everything pretty much.
It really is.
Puts it all together
Yep.
into one again. One thing I was looking at the references.
Oh, yeah.
I think that just we don't have to go through them, but I think it's interesting to note here some of the dates on some of these references here, like 1998, 1999, 91, 2002. I think 2002 is the most like
and that was
recent one,
Hashcash.
and that was Hashcash.
Yep.
And 1957 even. Probability theory, mathematics.
Yep. Yep.
So I mean, I just think all of this is interesting when people talk about, you know, blockchain and Bitcoin being the revolutionary thing that it is. It really was the concept of history, and it's pretty cool. Pretty cool stuff.
And I think we should, going along this, we should pull up this, let me see. Don't need to give away any details on my Amazon account here, but I'll just take a little screenshot here. This book, talked about by Craig Wright first. We've both read this book now. I think anyone that wants to, like, they're like, oh, this, Beach Boys are idiots. No idea what they're talking about when it comes to blockchain or anything like that. Like, you should read this book. It's very short. It's pretty straightforward.
Yeah, it was really short.
Talks about cryptography. It's $22 paperback, $10 in the Kindle. Okay. It's just interesting. Craig first talked about it in an interview a long time back. I was just curious, just bought it, read it on an airplane. It talks specifically about creating digital currency with the use of a blockchain. And this book was written in 2003. So,
whoa!
Did
you hear that?
Was that thunder?
Did you hear that lightning?
Yeah, that was loud.
Yeah.
That was pretty loud.
Yeah, not lightning, thunder.
Corey might not be with us tomorrow, so might need a new Beach Boy.
Tryouts start tomorrow.
Oh man, but yeah. Anyway,
but yeah, definitely check out that book.
Yeah, if you're curious, right? I mean, again, digital cash, as described in a chain of digital signatures, September 30th, 2003, published. Peter Weiner. It's all there. It's all there. Oh, and what's interesting the most, Corey, is that the whole book is really about economics and security as well. How to use economics to also secure online games. So,
yeah,
I don't know.
A lot of incentives in there too, like incentivizing people.
Yep. So,
all right,
cool. Well, that was good. Good. Wrap up.
This is the last episode that I do as a Beach Boy. It was fun.
Yep. It was good having you, Corey.
Yeah, I'm glad that we could at least conclude the Whitepaper series before I left. Also just quick plug too. CoinGeek conference. I think they should be announcing the speakers pretty shortly here. Any day now. Don't take my word for it, but
Roger Ver was added. Yeah.
He was added as well.
Pumped.
A lot of people, I don't know. I'm not gonna say it. Everyone just kind of feels like they're picking sides, and I think Roger going to the CoinGeek conference, little telling of the future.
Yeah, I think so too.
Or at least people's incentives to stay together. At least
There will be no
Maybe.
split of Bitcoin Cash. I wholeheartedly believe that. I actually, Jonald's listening. We still have a bet to make. So he promised me a bet.
Alright.
So cool.
Yeah, but go sign up for that CoinGeek conference.
Yes.
So you can come see us, see Roger, see currently Calvin, or not, well, Calvin,
Yeah, Kevin will be there.
Ryan Charles and Craig Wright.
Yep. And
All right.
no, and I'm excited. Oh yeah, look, they have the fiat payment option. So if you know someone who doesn't know what Bitcoin's all about but still wants to go, definitely send them here. They can pay with the old fiat system.
Yep.
But
Do it.
I'm pumped. Looking forward to that a lot. So
Very pumped. Yes.
awesome. Well,
All right. Well, good show.
good stuff. We'll let us know what you thought and
Yeah. Ask any
spread
questions
it,
in the
spread
comments.
it to all the core people. We're gonna.
Yeah.
I've been putting these on our Bitcoin, and has not gotten deleted yet. But one person, I got like 2 comments. I'm saying this is awesome. This is awesome. Clearly didn't watch it, but then one person was like, you know, whatever you call this. They called us something very rude.
Oh, what a shame.
But put it on our Bitcoin for us and see what see if people want to listen to the white paper. So, all right, Corey, we're at an hour.
All right.
Sign it off.
All right. See ya.